Welcome to Profitora Hub, where we break down the world of money, finance, and business in a way that is simple, powerful, and eye-opening. Today, we are uncovering something that affects almost every person on the planet. You deposit your salary, swipe your card, take a loan, or maybe even invest through a bank. But have you ever truly stopped to ask yourself how banks really make money? How do they grow bigger every year, build massive skyscrapers, and report billions in profits, even during economic uncertainty? Banks are not just safe places to store money. They are carefully designed financial machines. Every product they offer is part of a larger profit system. By the end of this video, you will understand exactly how this system works and why it is so powerful. Before we begin, make sure you subscribe to Profitora Hub, like this video, share it with your friends, follow for more deep finance content, and comment below with the word profit if you are ready to level up your financial knowledge. Now let's break down the top 5 ways banks really make money. Number 1. Interest on loans. The foundation of banking profits is lending money. This is the core engine that keeps the entire system running. When customers deposit money into savings or current accounts, the bank does not simply store that money in a vault. Instead, it uses a large portion of those deposits to issue loans to other customers. These loans come in many forms. Home mortgages, car loans, student loans, personal loans, and business loans are all examples. When a bank gives someone a loan, it charges interest on that loan. Interest is essentially the price you pay for borrowing money. Here is where the profit becomes clear. Suppose a bank pays depositors 3% interest on their savings accounts. Then the bank lends that same money out at 8% or 10%. The difference between these two rates is known as the interest margin. That difference might look small, but when applied to millions or even billions of dollars, it becomes massive. Mortgages are especially powerful for banks because they are long-term loans. A 20 or 30-year mortgage means decades of steady interest payments. Over time, borrowers often pay back much more than the original loan amount due to interest. Credit cards also follow this model but at even higher interest rates, sometimes exceeding 20% annually. This spread between borrowing and lending rates is predictable and steady. As long as people need homes, cars, education, and business funding, banks will continue earning through interest. This is the backbone of their business model. Number 2. Fees and service charges. While interest is the main engine, fees are the silent profit boosters. Banks generate billions from various service charges that many customers barely notice. There are account maintenance fees, ATM usage fees, overdraft charges, wire transfer fees, foreign transaction fees, late payment penalties, and more. Each fee may appear small individually. However, when millions of customers pay these fees regularly, the combined total becomes enormous. Overdraft fees are one of the most profitable examples. If you spend more than what is available in your account, the bank may cover the transaction but charge a penalty. That penalty can sometimes be larger than the amount you overspent. Similarly, missing a credit card payment results in late fees plus additional interest. Businesses also contribute heavily to this income stream. Companies pay banks for merchant services, payroll processing, payment gateways, and treasury management. Every transaction processed through a business account generates small fees. The power of fees lies in consistency. They do not rely entirely on economic growth or loan demand. They are built into everyday banking activities. This makes them a reliable and stable source of income for financial institutions. Number 3. Credit cards and consumer financing. Credit cards are one of the most profitable financial products ever created. When you use a credit card, the bank instantly pays the merchant on your behalf. You then repay the bank either in full or over time. If you carry a balance beyond the payment due date, interest starts accumulating. Credit card interest rates are typically much higher than regular loans. This high rate significantly increases profitability for banks. But the income does not stop at interest. Banks also earn annual fees on certain cards, especially premium cards that offer rewards and travel benefits. In addition, every time you swipe your card, the merchant pays a percentage of the transaction value to the bank. This is part of the payment processing system. Even customers who pay their full balance each month still generate revenue through these transaction fees. That means banks profit whether customers pay interest or not. Consumer financing options such as installment plans and short-term financing programs follow similar principles. They encourage spending while generating interest and service fees. Since credit cards are used daily for groceries, travel, subscriptions, and online shopping, this creates a constant and massive flow of income. Number 4. Investments and financial market activities. Banks do not rely only on lending and fees. Large banks actively participate in financial markets to grow their profits. They invest in government bonds, corporate bonds, stocks, and other securities. Government bonds provide relatively safe interest income. Corporate bonds and equities offer higher returns but come with higher risk. Banks manage this balance carefully using professional analysts and risk management teams. Many major banks also operate investment banking divisions. These divisions help companies raise capital by issuing shares or bonds. When a company wants to expand, launch new projects, or go public, banks provide advisory services and underwriting support. For these services, banks earn substantial fees. In addition, banks assist with mergers and acquisitions. When two companies merge or when one acquires another, banks often act as financial advisors. These deals can generate millions in advisory commissions. Some banks also engage in currency trading and financial derivatives. While trading involves risk, it can also produce significant profits when managed strategically. This diversification allows banks to generate income from multiple financial channels rather than depending solely on traditional loans. Number 5. Wealth management and asset management. The final major profit source is managing other people's money. Wealth management services cater to individuals and businesses seeking professional financial guidance. These services include investment planning, retirement strategies, tax planning, estate planning, and portfolio management. Clients pay management fees based on the total assets under management. Even a 1% annual fee on a large portfolio can produce substantial income for the bank. High net worth individuals often prefer banks to manage their investments because of expertise and convenience. Corporations also pay banks for financial consulting, risk analysis, and treasury management. Asset management divisions pool money from many investors into mutual funds and other investment products. The bank earns management and performance fees from these funds. Since these fees are typically recurring, they provide stable, long-term revenue. This income stream is less dependent on borrowing demand and more focused on advisory expertise. It strengthens the bank's overall financial position and builds long-term client relationships. When you combine all these methods together, you see the full structure. Interest from loans builds the foundation. Fees add steady support. Credit cards accelerate consumer-based profits. Investments expand revenue streams. Wealth management creates long-term stability. Banks are structured to earn from both borrowers and non-borrowers, from individuals and corporations, from local transactions and global markets. It is a highly diversified system designed to generate profit in multiple ways at the same time. Now, the next time you deposit money, take a loan, swipe your card, or pay a banking fee, you will understand what is happening behind the scenes. Banks are not just holding money. They are actively using financial strategies to multiply it. If this breakdown helped you understand the banking system better, make sure you subscribe to Profitora Hub, like this video, share it with friends who want to understand money deeply, and comment below with the topic you want next. Follow for more powerful insights into finance, business, and wealth building. Thank you for watching Profitora Hub, and we will see you in the next video.